Hello everyone, welcome to a new video full of sector rotation, relative rotation graphs, and this week seasonality and long-term charts, long-term completed monthly bars here on Stockcharts television. My name is Julius de Kempenaer and I'm presenting to you from Amsterdam in the Netherlands. As I said, a new month has started, which means that we're going to look at completed monthly bars for the month of June and an attempt to look forward into the seasonality and what we can expect from seasonality and sector rotation in the coming month of July. As I said, we just finished the month of June, and let's have a quick look at the performances across the sectors over the last month. So I'm using the sector summary for that and set the period to 1 month. It's not exactly last month because it's, in this case, because I'm recording this after the close on July 1st. It is exactly 1 month back. So it's the 1st of June to July 1st. So today's performance is included and the 1st of June is excluded. Nevertheless, let's give a pretty good idea about what happened over the last month. And what you see is a pretty big difference in performance between the top and the bottom percentages. So technology is leading the table at 8.65, followed by discretionary at 4.25, and then it goes down and we start going into the negative from financials onward, and that grows to a negative 4.5 for materials and minus 6.2 for utilities. So all in all, let's say it's a difference of almost 15% between the top and the bottom in terms of performance. It's quite big. Anyway, what it tells me is that there is the sector rotation is alive because there are big differences in sectors. If you would have invested in technology, you would have gained 8.65%. If you would have invested in utilities, you would have lost 6.2%. So there's definitely a case to make for sector rotation, and it is ongoing. Now, we've also seen that the way it is ongoing is quite volatile. Lots of differences, lots of sectors picking up and losing again and picking up and losing again. That's what we also visualize in the relative rotation graphs that we talk about on the show almost every week. So the bottom line is that sector performance or sector rotation matters. It is there and it's very, very much alive. And this is what we've seen last week. As we finished the month, I will use this episode to take a look at the finished or the closed monthly bars for the month of June and see how we can use those longer term trends, those longer term bar charts we're going to look at to paint the bigger picture of what's going on. So I have a chart list for that, which I have shared, and I put the link in the comments of this video as well. And it has the indicators that I use for the sector rotation model. We talked about that 3 weeks ago. And then there is a whole list of monthly sector index charts, and we're going to walk through all of them and see what happened with the monthly trends. And the first one on the list here is communication services. And what you see is that it is holding up well after that break above that major high that was formed in 2021. And we're kind of on the way to the all-time high for communication services, which was set in 1999 around 335. So that is another 25 points to go. In the most recent rally, I think we can all agree that this is still in an uptrend, and last month was a pretty good month. That last little flimmer here, that is only today's pricing for the 1st of July, so we're going to concentrate on that closed bar right here. And you see that this communication services sector is still well on the way to target its all-time high and possibly higher, and the trend is still up. We can handle a drop back to the previous resistance, which is now expected to act as support around 290. So without a doubt, this sector will see some sort of a setback at some stage, but it's very hard to, we need a lot more downside to turn around this uptrend. So pretty positive outlook for communication services, longer term. Here we have consumer discretionary, and you can see that this sector has a lot more trouble. I mean, the rally and the trend is obviously still there since 2009, but if you look here, we haven't done much since 2022. We're actually pushing against overhead resistance coming off these highs here. And let me zoom in a little bit on that chart. So here you can see how we're kind of running into resistance. And over the last 1, 2, 3, 4, 5, 6, 7 months, consumer discretionary has not pushed higher. The trend is still up, but that's because the series of higher highs and higher lows is still there. Kind of a similar situation we see in consumer staples, although this sector has reached its all-time high, it has tested its all-time high, which was set in April 2022. But if you look at the overall performance over this complete period of time, it's more sideways. Only the last 2-3 months we managed to take out that first level of resistance, which was around 814, 815. Now we pushed higher, and then we didn't really do much over the last few months. We're like the last 3 months we're in between this resistance zone, so to say. Again, the trend is still up because, as I said, it's higher highs and higher lows. But you know, we do need a break to all-time highs to actually push this move higher. Otherwise, it's going to be again back to sideways for consumer staples. And here we have the energy sector. Tested all-time high levels, which were set in May 2014, already back in 2022, 2023. This is 22, this is 23. Here is 2023 again, and then we did it again 2 months ago with this push to 756, but we closed the month at the low around 715, and this is a failed breakout, usually not a very strong sign. It means that the sellers were coming back, and they were coming back pretty aggressively, pushing this sector down back below its previous resistance level. We were expecting this to start acting as support. That didn't work. Usually not a very strong sign. And we're now, you know, going sideways just below that old resistance level, which will very likely again come back as a resistance level on the way up. The trend is still up because we have higher highs and higher lows, because this high was a higher high and we have a higher low in place. So the trend is still up, but there is a hell of a lot of overhead resistance in this 720 area, I'm going to say. And then here is financials, another sector that is struggling with its all-time high levels. If you look at the cluster of highs that was set here at the end of 2021, start of 2022, that's all happening around just below 700, 695, 700. Now we got this sort of sideways move. We started the year, we broke higher, and then for the last, I'm going to zoom in here a little bit. For the last 1, 2, 3, 4, 5, 6 months, we've been moving sideways. We've not been able to take out that overhead resistance level. So that is getting stronger and stronger and stronger. You know, the longer it takes before a resistance level is taken out, the stronger it gets. And that means two things. If the market really cannot take out that resistance level, we will very likely see a setback. And in the case of the financials sector, we may see it dropping back to that previous resistance, now support level around 620. But if it breaks a level that has been tested a lot of times, it's usually going to be a very aggressive rally after that. And the reason is that you got to translate all these tests in supply. So a peak is formed because people are selling. There's more supply than demand. Demand is not strong enough to take out all that overhead supply. Takes a while. And then when it happens, when that overhead supply all of a sudden dries up and there is still demand and it's aggressive, I always like to compare that to a spring that's being wound up and wound up and wound up, and all of a sudden there's going to be a lot of tension in that spring. And then when you let it go, there is a lot of energy being released when that spring lets loose. And very often that's what you will see when a market breaks such a long-term overhead resistance level. If we go to healthcare, again, kind of similar picture. Massive rally, still there. The trend is also still labeled as up because since here we've got higher highs and higher lows. But we are having trouble to really push to new all-time highs. And I'm going to once again zoom in on that last bit. You can see that since this is February, the healthcare sector has not been able to push above that high, which was 725. And we're still moving sideways. Again, the trend's up because higher highs, higher lows, but we do need at some stage to take out that 1725 level to actually activate that uptrend, reactivate that uptrend and make it move higher. Because if you look at the bigger picture, this sector has not done much since late 2021, only marginally higher. As a matter of fact, I think like the high of April 2022 was 1672, and we're now 1690. So that's almost nothing. That's no return at all. If we go to industrials, this is one of the sectors that has been following through nicely. It's been, moving in a rhythm of higher highs and higher lows. It's still doing that. But here also you see that we have set the high in March. And since March, we've been moving kind of sideways or slightly lower. And this sector seems to be in the process of, digesting this overhead supply. Again, all these trends are so strong, and we've seen, a lot of these sectors have broken overhead resistance and are now, there's a lot of leeway for these sectors to decline without breaking that uptrend. And it's the same case for industrials. This sector could go down to 950 from currently 1020 without hurting the current uptrend, because we've just put in a high and we're just looking to put in a new, probably higher low. And even if that low comes around 950, it's still going to be higher than the 813 that we had back in October 2023. So again, these are longer term charts. These are monthly charts. They look for longer term trends. And over this time span, these sectors can make very decent moves of a very decent magnitude without changing anything in terms of trends. And I think that's what you need to keep in mind. And also when you use these charts to build the bigger picture for the market as a whole, this is what you need to keep in the back of your mind. And I'll try to wrap it up in a minute, but that's what this is all about. What we're trying to do here once a month, going over these longer term monthly bar charts, figure out what is the long-term trend for these sectors. Is it still going up? What are the risks? What are the opportunities? So here is information technology. Everybody loves that information technology. And again, it was a very good month for June, as it was in May. And it pushed to new all-time highs, new closing highs. Obviously, that uptrend is still there. But here also, you will see the same situation that this uptrend, this technology sector index, the previous low here is 3490, and we're currently trading at almost 4400 in the technology sector index. We can drop what did I say, 3490, 3500. We can drop like 800-900 points in this index without hurting the uptrend. If I would draw in, why don't I do that? I can put in a trend line here. No, I would violate my own rule. This is a log chart, and I just don't want to draw straight lines on a log chart because that just doesn't make any sense. But the trend is very clearly there: higher highs and higher lows. So still driving the market. If you look at the grid of large, mid, and small caps and growth and cyclical, it's still large cap growth, and then predominantly technology stocks that are driving the market. The consumer discretionary is picking up a little bit now, but it's still all concentrated in the technology sector. So that low footprint, that narrow foundation is still there, and that is on a breadth picture. We're looking at the long-term trends here, and all these monthly charts are still looking good to pretty good. I haven't seen one that would worry me in terms of, hey, this is a downtrend as of yet. And spoiler alert, it won't happen in this session. So here is the materials sector. Again, that's another one that's been pushing against overhead resistance. We peaked above it back in March and April, but then dropped back. And we're now resting at overhead support around 550 for the materials index. Again, the trend's still up because it's higher highs, higher lows. That rhythm is still in place. But there is a lot of overhead resistance coming off those 2021, 2022 highs. We tried it, didn't work. Again, here we're now resting at a former resistance level, which is now acting as support, holding up well so far. But this is the stuff that I'd like to keep an eye on, because what you really want to see for the market to push higher and to get a broader participation is for sectors like this to actually break higher, to get out of that more or less sideways pattern. Here is the real estate sector. If I have to label something as the best and the worst, and technology is probably the best, and I think that real estate is the worst. It's neutral because you can see here that, it depends a little bit on how aggressive you are with your labeling, but you can see here that we have a lower low and we have a higher high. Maybe we could label this as lower highs and lower lows, and it would be a downtrend. But if I look at this, if I eyeball this, I'm pretty confident that this is a neutral trend, and we will see real estate spending its time between overhead resistance and support here at the low of that range. It's not a sector that's pushing against all-time highs, that's for sure. And then we've got utilities. As you can see, this sector is trading at levels that we've seen back in 2020. Not a lot has happened. Big up move, big down move. We're kind of in the middle right now. The trend is up because from here we see higher highs and higher lows, and you can see the decline coming in now. And here also there is overhead resistance, former overhead resistance here around 335, which is now expected to catch the decline, which is underway since May, since the month of May, and this was June, was a weak month for utilities, and we're dropping a little bit further. Within this uptrend, we could go probably as low as 304 without hurting this uptrend. And I hope you see the theme when I talk about these sectors, that they're pretty much all in uptrends except for real estate, and they all have, because they've had such big rallies, they can come down quite significantly without breaking their price uptrends. And I think that's the characteristic of this market. We're still in that uptrend. There's no doubt about it. But because of the rallies, there is decent room for corrective moves. And I think that's a bit of the risk that we're seeing in the markets, and that's the risk that I've been talking about over the last few weeks. And the big question as an investor, of course, is, do you really want to chase those markets higher, running the risk of buying at a peak and having to sit through a first corrective move? I don't have a definite answer to that. There's a couple of sectors that are looking really good, but there's also a couple of sectors of which I think maybe not. And that reflects on the S&P 500, especially when you look at the breadth story that we shared here a couple of times already, which is very narrow and driven only by major technology stocks as well as major consumer discretionary and communication services stocks. And this all ends up in an S&P chart that once again pushed to new highs, new high, new closing high for the S&P 500. Really, really strong. But again, very narrow base. Nevertheless, uptrend fully intact. And if I zoom in on that last bit here, maybe do that aggressively here for the S&P, you can see how this rhythm of higher highs and higher lows is still there in the monthly bars, but also that the last low on a monthly chart was formed 49.50 back in April. So 49.50 to almost 5,400. That's a pretty decent decline. So the S&P can go through a very decent decline without hurting the uptrend. Difficult story, but that's what it is. The longer term investors, uptrend still there. And I hope when you walk with me through all these charts, that you saw that there were a few that were really pushing higher. Communication services and technology come to mind. And then you saw quite a few that were pushing against overhead resistance. They're trying, but they haven't managed to break higher. Materials, energy, industrials was higher, but it's now coming lower. Go over these sectors again, and you'll see that there's quite a few that are pushing against that overhead resistance. They need to have that push to move higher. If that doesn't happen within the next, I don't know, I'm just going to throw a number here, 2-3 months, at some stage overhead supply will win, and it'll sort of exhaust the buyers, and they need to regroup to refuel. And the question is when that happens. If we get the break of that spring and then it move higher, we could even see an acceleration of the S&P 500. I'm in the camp that is very, very cautious right now, mainly because of the narrow breadth and the narrow foundation of the rally. It's only a handful of stocks and 2 sectors that are really driving the market, and that is, I feel not super comfortable with it. Hey, but if it happens, if the market moves, we got to follow. So how would I position myself as an investor? If I have my long positions in the right sectors and the right stocks, I wouldn't sell them right now because you still see it going higher. But I'd be raising my stops. I'd be being very, very much more cautious. Maybe bring in some hedges to protect your gains. And I would not be, if I would have a brand new portfolio, I would not get fully invested at this point in time. Try to pick and choose, be very, very picky, be very, very careful, be very, very cautious. And I wouldn't, put all my eggs in the basket right now. I think that's the best summary that I can give you based on these longer term trends. The other segment I talk about when a new month starts or is about to begin is seasonality. And that's an interesting theme at the moment because if you look at the seasonality for SPY, then we all know the adage, the saying, sell in May and go away, but remember to come back in September. And if we look at the seasonality for SPY, and let's get that to 20 years, you can see that July is actually one of the strongest, together with April, months of the year, with an average return of 2.6%. That's pretty decent. So that entire thing of sell in May, it kind of works, but July seems to be the exception. The only thing is, what I've noticed, if you scroll this bar back and you go back in time, and let's say that here we have now 1993 to 2012, you can see that July was one of the weakest months. So that is a change in characteristics, which is very notable, I think. We got to keep that in mind. The summer months are not as quiet as we may have gotten used to. It's probably the best way to say it. If I bring in my spreadsheet where I've collected all the monthly performances and outperformances for all the sectors. By the way, this is, let me get this right here. I've broken it down into offensive, defensive, sensitive. These are the months where, so SPY is in price terms. So SPY is higher or lower. That's the amount, that's the percentage. The amount of months, the amount of occurrences where SPY ended the month higher than it opened. And what you can see here is that July, 75% of the time, SPY actually ended the month higher than it opened. And it's, as you can see, it's one of the stronger months. And the sectors are showing the outperformance. So the percentage of months where the sector outperformed SPY. And there's already an interesting observation here, because the market itself was higher 75% of the time. But if you look at the sectors, there is not really something that is standing out. If you look here, then it's all 45. So real estate at 60% is okay-ish, but it's not fantastic. Then we got 55, 45, 40, 63. Energy 55%, and then there's technology 65%, and industrials 40%. So this indicates that the majority of those gains for the S&P 500 for SPY were coming from communication services and technology on average over the last 20 years. That's something to keep in the back of your mind. This is also showing narrow breadth, basically. That's what it is. If we look at the percentage points, then you can see here that the average return for SPY in July was 2.4%. It's a decent gain. And if you look at these are the relative performances for the sectors versus SPY. You can see that energy outperformed, real estate outperformed 1.2, that's a decent one. Discretionary outperformed 0.4. These are all negative. We got communication services outperforming 30 basis points. Energy underperforming 1.5. And then here is technology outperforming on average 70 basis points over the last 20 years. So the way you read this is that the expected performance for the technology sector is 2.4 plus 0.7. So that's 3.1% price performance is expected for the technology sector, which means an outperformance of 70 basis points over the S&P 500. Will that again work this year? I don't know. It is questionable, but it is an interesting statistic to keep your eye on. What is also important to keep in mind is that these are monthly stats, so they go literally from month to month, and the market obviously doesn't move month to month. So technology has already gone through at least one strong month, and maybe more is to follow. So you can see how June supposedly was going to be a weaker month for technology. Well, that didn't happen, and it outperformed way more than 0.1%. So it's very well possible that these expected strong months for July and August have come in early. It still means that we're expecting a very good month of July for the technology sector, and also actually for the S&P 500, because it's not nose diving to 30% or 40% actually. So in the last 20 years, these are the stats. It's pretty good, and it really starts to pick up towards the end of the year. So we're in a difficult period with July being the outlier. And then we've got technology sector kind of expecting to outperform, and August is expected to be even better. All in all, my takeaway from this seasonality point of view is that we're expecting a pretty strong month of July for the market as a whole. That means that a super strong decline is unlikely to happen. If the market starts to digest, so be it. But the seasonality is not pointing to a very serious decline. And the performance seems to be coming from communication services and technology, to a little lesser degree of real estate. And all the others they can add, but they can also drag it a little bit down. And if we put all of this on the monthly RRG for the sectors and see where their performance is likely to go in terms of relative rotation, then we see here, this is the monthly RRG for the sectors, and you can see that communication services and technology are the only two sectors inside the leading quadrant based on the positive seasonality for those sectors. It looks as if they will remain there for this month and maybe add a little bit to the performance. And it also adds to the overall view that the current rally is still on a very narrow footing, but it keeps going higher and it keeps continuing, and you really don't want to swim against that tide. So wrapping it all up, monthly charts are showing uptrends mostly across the board for all the sectors. Very strong trends for communication services, technology especially, and quite a number of monthly charts that are pushing against resistance and not breaking. So that is underscoring the narrow footing. When we move to the seasonality part, we see a strong expectation for the market as a whole, mainly driven by communication and technology stocks, with a pretty decent seasonal expectation. And that is confirmed by a continued positive rotation for those sectors on the RRG. I think the best way to describe this market is that it's continuing higher on a very narrow path still. That's what it is. We got to deal with it, and we will take another look next week, same time, same place. Thank you for watching, and let us know in the comments what your thoughts are.